the rental value of a property is being used as the valuation, the calculation for property tax. Why is that the case? In fact, is this the best way to calculate property tax?
Right. So the advisors to the Ministry of Finance, which would be from the Ministry of, the Valuation Division, and they would be the technical experts, they did say there were other ways of doing it, and one of them was capital value. But they said when you finally applied it, there really was not a major difference. But the reasons they gave us was custom. People were accustomed to using rental values as a means of paying taxes. They also said that in terms of using the capital values, you found that particularly in the rural communities, there was very little sales turnover of properties. So using capital values was not going to be that helpful. And then they said there was a stability using rental values rather than capital values because they, according to them, the change in capital values was far slower. So they did look at it. It wasn't as though it was just going on your rental value and that's the end of the story.
So it's slower with capital values. The rental values being quicker to update is fairer.
But let's see how they come to it because I think that's important that people understand how they arrived at it, which is why many people do not know this. But actually in May 2010, April 2010, we actually had bills ready to send out. Yeah, we had bills, everything ready to set out. And the Prime Minister said, let's wait, because he was calling elections, let's wait till after. But I really wanted to set it out because I was confident that when people saw what they were really going to pay, by the time we reached the real, when elections should be called, they would realize that they were not paying all that what they were made to believe. So let's see how they worked it out. So you have 4 classifications: residential, you have commercial, you have industrial, and you have agricultural. When it came to residential and commercial, they would use certain parameters. They'd look at where the property is, the size of the property. It wasn't an exact science. And we had OJTs. We had thousands of young people out there using the guidelines that the commissioner valuations gave them. So it's not true to say that we didn't have sufficient numbers to put on what they call evaluation rule. Because the first thing that has to happen is the properties, depending on their classification, have to be put on the valuation roll using the formula, and then it would be sent to the Board of Inland Revenue Division. And it is there that they have prepared the assessment rule, which is the assessment of taxes. And how we were going to do it, there were 3 major things we did, and which I felt was very misleading of the then backbencher Dr. Roy, because he knew that couldn't be true, because we had to represent it to Cabinet. Even before I came there, they wanted to modernize the system, because one of the things was everybody had to go to their particular, what you call it?
Local government office.
Right, and then they'd pull out these big old books and they'd look through it. You remember that? Right, so what we were using, we had computerized the entire system so that you could pay your tax anywhere you wanted. In fact, I closed down the Toko office because I said, imagine the gas to reach Toko and you living in Port of Spain is more than the tax you have to pay at the time, because they were not part of the municipal corporation. So we closed down some of the offices, and the idea was you could pay the tax anywhere you wanted, any office you could go to, no matter where you lived. And secondly, we had modernized it in the sense that you did not have to come into the regional corporations to pay. We did it like T&Tech. You would send you a bill, and it would set out all the information, including your right to object, what you could do, etc. And we had those bills ready to send out to taxpayers. And we knew, let me just say this very clearly, we understood that it was an ongoing exercise. But we also understood that the exercise in terms of them going out and looking at properties and revaluing, if you did not, of your own accord, bring in your property, your deed, whatever it is, and we found it out, you'd have to pay the taxes that you should have paid before, plus you would have to pay a
Fine.
fine, okay? So we understood it was an ongoing process, but we had to start. So the 4 categories, let's say residential and commercial fell into the same category in this sense. To work out the annual taxable value, the first thing you did is value the property. So if your property is in Quaico, as opposed to LSD Park, you know there's a difference in the size and how many bedrooms, etc. So let's say the property was worth $800,000. So that would be the capital value you would see. But what you're looking at is to find out, this property, if the person were to rent it, how much would they get for it? Mm-hmm. And now it could actually be rented, or you'd have to consider what it would be rented based on what was being rented for similar properties. So let's say you decided based on that it was $2,000 a month. That would give you the annual rental value, $2,000 a month, $2,000. But what you wanted to get at was the annual rental value. So you took that $2,000, and Section 14 of the Property Tax Act allowed you to take away 10% from that annual taxable value. Why? Annual rental value. Why? Because they recognize properties have a time when you lose a tenant, you do have a tenant, so they recognize that you needed to take that into account. So that when you came to the annual rental value of $24,000 based on the value of the property if you were to rent it, hypothetically or actually at $2,000, the annual taxable value would be $24,000 less the 10%. Yes? And that would give you $21,600. And then you would apply the property tax to the $21,600. And your annual taxable value was $648.
The value of
$640.
the value of
a year
rent
for
of
the
a
year.
property could change depending on, let's say, for example, if a
Do
house
renovations
needs
and
renovations,
stuff.
for example. Is that also taken into consideration?
Yeah, because that was the problem. The problem was, which maybe I didn't make myself that clear, but definitely the properties that fell outside the municipal corporation, they had not been revalued since 1948. Uh-huh. So no house, big house, all kind of house, but they're using the value of 1948. Okay? So your duty was to say, look, this is what my property is worth now. Now, if you think you're going to get away, yes, you may get away the first year, but the exercise was continuing, and you were going to pay a penalty, and we were going to backdate it to when you had renovated it. Okay? Yeah. So when it came to commercial property, suppose the property was valued at $1 million, but what you're looking at, how much could you rent that commercial property for? Again, you could actually be renting it for this, or we're saying based on where it's located and type of business, etc. So we use $20,000 a month would be the annual taxable value. Again, we apply the Section 14, took away 10% out of it, so you came down to $216,000, and then, only then, you would apply the property tax of to commercial property. It was 5%. So you would end up paying for $1 million property, which you rented for $20,000 a month. You would end up paying $10,800 for the year.
And if it's a commercial property that you're not renting, it's still
it doesn't
earning
matter.
you money. It's still earning you money.
Whether earning you money or not,
yeah,
you're good.
But it's a lot more than the tax would be.
Exactly. And then let me finally finish the last two. Industrial and agriculture. Even the agriculture is even more amazing. If you had agricultural land, let us say the agricultural land, they looked at the open market value. That is, if you went to market and you were looking for a sell, you're not really having to sell it, but suppose you did. What could you get? So let's suppose you could have gotten for that property $800,000, which is the capital value, not so? But you didn't. For the annual taxable value, it would be $16,000 because you are looking at you're applying 2% to the annual taxable value. But then after you apply the 2%, the property tax for agricultural land, the property tax for that was 1%. So you paid $160. $160 for the entire year. Yeah, but nobody was listening. We sent out booklets upon booklets upon booklets. We had meetings upon meetings upon meetings, but we were being drowned out, and it was fighting and losing goals. A big difference would be with industrial property. What I think happened before is that if machinery and property was not housed in a building, I do not think that they would tax it. But now they've made it very clear. If it is outside of a building, I guess all refineries and all these industrial things, they are subject to the tax. And it's a different formula. It's at 6%. And they look at the installed cost. And I guess they would look at the current market resale value, which is to answer your question, they must take into account the depreciation on that property.
Precisely, yeah.
Okay, so I think I've given you enough information to tell you that what people were being telling you, and that's why I was so gung-ho about sending out those bills, because I knew we had 2.5 years supposedly left. I knew by that time that people saw what it really was, that they would realize, but it's not unfair. And in fact, the people in San Fernando had been paying on the valuation of 2008 because they had been revalued, and they were paying at 8%. And nobody from San Fernando argued, nobody. But when this became a political because the bell rang, so it became a political thing, an axi tax, so they drowned you out.
I wanted to get to one of the points, because you spent some time explaining valuation, and valuation is one of the key issues that you have now, because amendments were made to how the property tax was treated, and your concern is that, well, by requiring, you said it, we knew that it was going to be a process back then, right? Now the government is saying, well, no, we need 50% minimum before we could implement.
Right. And I have this right in front of me, because this is documents. I don't think they are like Trump. I have no cabinet note or minutes in front of me. But these were the kind of notes we were preparing. And I'm just reading from this. Bills will be mailed to taxpayers during the period April 2010 to June 2010. Taxpayers are expected to receive bills at the District Revenue Office, at the cities and boroughs, but we also went further and said we would also then computerize the system and send it through here, like a TNTech bill, a TSTT bill. So you can see that even though we knew we did not have enough, we knew we felt that enough, but so the change that he made, and in my respectful opinion, I may be wrong, but from day one, when the new minister came in, every single budget, in fact, in his first budget, he had everybody scrambling, including myself, to get their deeds and get their things. And he was asking for information, which he couldn't ask for, because when you read the Valuation Act, it did tell you the kind of information you had to provide them with, because it is only where you did not provide them with the information or inaccurate information that they would send you out a notice, and you could be in trouble then. But the fact that it made it seem as though it was incumbent on us, and if we didn't do it, we would be liable, that was not misleading. But the issue that you're asking me to address is, as I just read out to you, when I was the minister and I had oversight over this project, you see that we were signing out bills from April, right? We didn't have all the, we knew that and we understood that. But the change that was made, from my understanding, reading the amendment 7A, I've seen this thing, the valuation division does not send their annual taxable value. They work it out and send it now from their valuation rule to Board of Inland Revenue to their assessment rule, where they would send out the bills, right? Because they're the ones collecting the tax. Then said, you will not begin that exercise of sending out for the payment of the taxes until we have more than, or I think 50% of industrial, 50% of residential, 50% of commercial. So what is that to me? That's a stalling tactic, because we're going to be here for the next 2 years. I want to know how they're going to make that determination. And he's going to come and talk about the process of doing it, and they reach about 40%. And I think that was a stalling tactic. The other thing that they've done too, which I considered, maybe it is a good idea, but it reminds me of the procurement legislation of you have a procurement act passed but no regulator. So then now you say, which might be a good thing, instead, if you have an objection under the old Valuation Act and the Property Tax Act, if you had an objection to how much you were either being overtaxed, it wasn't your property, and owner didn't just mean that you owned it. If you had the agent, if you were in control of, if you were renting, you know, it was a very broad definition. But you had to make your objection to the Tax Appeal Board. Now it's a tribunal. You have to set up that tribunal. And I suspect you have to have regulations governing that tribunal. So there are two things. You have to have more than 50% before you could start sending out assessmenting. Why? And then you have to now say, no longer go to Tax Appeal Board. Okay, maybe you have a good point. It shouldn't be the Tax Appeal Board because they have enough work. Set up a special unit to deal with tribunals for objections.
Well, Karen,
but you know what is the consequence of that?
It's just going to take longer.
We're going to be hearing about it in what's the next budget, where they've reached.